So from a macro perspective, I think the greatest risk is the one that we can't see yet. It's been an unusual year in the sense that so far as we close out February, it's been a phenomenal year in terms of international debt capital markets issuance from Latin America. We saw the biggest January ever in terms of new issue volume. Credit spreads have been consistently tightening. Even in Mexico, which started off a little bumpy post the US elections, has seen a very nice recovery in CDS spreads. The currency's bounced back. People seem to be shrugging off some of the near-term risks that might be posed by the Trump administration. When you look at Colombia, which is still struggling with getting its fiscal house in order and inflation's coming down, but maybe not as quite as fast as the government would like, that hasn't stopped the powerful rally that has been powering really across Latin America, across emerging markets, from lifting all the boats. So in a situation where, against expectations on, say, November 9th, day after the election, when people were expecting a much bumpier ride, it all seems to be blue skies. And in situations like that, what concerns me is what's the risk that we don't see. What we've been telling clients from a markets perspective, so this isn't necessarily specific to the Andean countries, is that with the Trump presidency has certainly shown itself to be, shall we say, unpredictable, and that we fully expect there to be pockets of volatility that might be driven by an unexpected tweet or some policy move that hadn't been anticipated by the markets. But that what we've seen in the last year to 18 months is that whenever there's a dislocation that causes credit spreads to widen out or markets to seem to seize up, they are very short-lived. And so what we think is likely, or the new norm, shall we say, under the Trump administration, may be pockets of volatility driven by unpredictable and unforeseen policy initiatives that don't really last that long. From a more country-specific perspective, the level of political discontent with the Bachelet administration in Chile is palpable. If you go to Chile, everybody's pretty unhappy. That it certainly seems like they're heading in the direction of an election that would put a more pro-business, more orthodox policy president in place. So that would be a good thing. Anything that might cause that expectation to get disrupted would be problematic. For both Peru and Chile, they certainly are liking the very powerful rally we've seen in copper and base metals more generally. If that continues, that certainly ought to have spillover positive effects for the rest of the country. There are certainly those out there who feel that the rally in base metal prices has been overdone too far too fast. If there was something that caused there to be a repricing or correction in copper prices, that certainly would be have some ramifications for Peru and Chile, and certainly the most likely source of that would be an unexpected perception or reality that Chinese growth is underperforming. So I think at the end of the day, the rally in commodities owes a lot to a perception that China is back on a more stable growth path, and anything that would undercut that, certainly, as we've seen time and again in Latin America, would have very negative repercussions for the region. And then finally, in Colombia, certainly the government, as we've been hearing at this conference today, has made very good strides in bringing inflation back down towards the target, though, as the governor of the central bank pointed out in his remarks, they're still a far way from that target. If those positive trends continue, that's all good. But the fiscal reform that was adopted was somewhat less than people had hoped. And so there are, I think, some concerns that although in general the policy direction that the administration is taking is going the right way, it's going a little slower than many observers would like, and that that could cause the pace of the recovery, or at least in the market's perception of Colombia, to be slowed down. So my perception is that for a while now we've been expecting the credit conditions in the Colombian domestic bank market to tighten and force people to look abroad. But my sense is it hasn't really happened yet. Certainly not for pesos. So I think when we talk to clients that may be of a size and sophistication to think about the foreign markets, they still are finding peso funding from local banks to be quite attractive. A year ago, we had a view that that was going to start to get more tight, there's only so many large banks in Colombia, and as they hit credit constraints in terms of the amount of exposure they could have to the major Colombian economic groups, that might force people to look for other alternatives. I don't see that that's really happened yet in peso funding. I think that if we did see a sustained recovery in the Colombian economy, so again, as has been discussed at today's conference, if you saw growth rates going up more towards 4 or 5% per year, so that the demand for credit started to get more robust, then you might see more of a constraint showing up. But as we saw from the central bank governor's presentation, certainly credit growth in the corporate sector has been declining for the last couple of quarters. So that hasn't really created a situation yet where I feel like there's been enough of a constraint in the availability of local credit to force people to go into the international dollar market. And certainly, I'm the debt capital markets guy, so I can't necessarily speak to what's being done in loans, but there's been a pretty minimal number of bonds coming from Colombia. The Tecnoglass bond was an interesting and notable exception, but I think for the most part, utilities and other large consumers of credit in Colombia have been able to take care of their needs in the local market without finding funding costs to be particularly compelling in the international market. Certainly in Peru, what we're seeing as SMBC is a lot of things going on in the power sector, both refinancing of facilities that were put in place for construction and people looking at other sources of credit for new construction within the generation space. And more generally, as is well known, both Colombia and Colombia and Peru have a very big government focus on infrastructure. So as a bank that has a very good track record and pedigree in financing infrastructure projects, both on a project basis and on a corporate basis, a lot of our time is really spent looking at 4G in Colombia, looking at generation and transmission projects in Colombia. In Peru, also a lot of generation, also toll roads in Peru. What will be at some level, it's what you would expect in countries that have infrastructure deficits. Looking to finance infrastructure projects is what you'd expect. I think the interesting and maybe harder to answer question is, what would it take for corporates to start looking at the dollar market as an interesting alternative? And here again, what we're seeing for companies that don't necessarily have a desire or a rationale to fund in dollars, that in both Peru and Colombia, the availability of bank financing and local capital market financing in domestic currency has been pretty compelling, and that the need or pressure to diversify funding sources by going to the external dollar market hasn't really been there. I think a precondition for that to happen would be a return to more sustained high levels of economic growth, so that just the demand for credit goes up. I think when that happens, you are likely to see, as domestic funding costs go up, and at the same time you see a compression in credit spreads on dollar funding, those two in tandem ought to create conditions for companies in both Peru, Colombia, and Chile as well, to start finding the dollar market more attractive. So the first of those conditions is certainly there. We've seen a significant compression in credit spreads. Where we sit today at the end of February, there continues to be pretty modest expectations about what the US Fed will do. Market is still only pricing in 25 basis points increases over the course of the year. So the base rate is not likely to go up a significant amount, barring unforeseen occurrences. And so with the compression of credit spreads and pretty tame dollar rate environment, it wouldn't take that much of an increase in domestic funding costs for people to start thinking that the dollar market is looking more attractive. Certainly, as a capital markets, a debt capital markets professional, we hope that that happens, and certainly the demand by investors for emerging market and Latin America paper has been seemingly limitless. So the window is there. We're just looking for people that are ready to step through it.